In this video, we're going to talk through 5 multiple choice questions that might seem a little bit intimidating at first. And that is auditing transaction cycles. Auditing transaction cycles is very important on the CPA exam because this is the work of the auditor. When studying for the audit exam, you're going to see a lot of scary words such as management's assertions or substantive testing. But as far as I'm concerned, you could throw all of that in the garbage. So there are 3 very important things that you need to remember when attacking transaction cycles. And that is the various internal control departments, the documentation that is created by management, and that same documentation that is tested by the auditor. All right, so diving right into it, we're taking a look at this question that says, tracing shipping documents to pre-numbered sales invoices provides evidence that... Okay, so when scanning through this question, I want your mindset to be really thinking about the documentation that is getting tested by the auditor. All pre-numbered sales invoices were accounted for, all goods ordered by customers were shipped, no duplicate shipments or billings occurred, or shipments to customers were properly invoiced. Okay, so if we were to think about the documentation that was getting tested here, when you're thinking about the revenue cycle, we're immediately thinking about the initial documentation that was created in the shipping department. Okay, so if we think about our internal control departments, we know that the shipping department is going to be creating shipping documents. This is then sent over to the accounting department where sales invoices are going to be created. And they're going to be created by matching the initial sales order with the shipping document with the newly created sales invoice. So if we are tracing from that shipping document to the pre-numbered sales invoice, this means that we are checking to make sure that the paperwork for the goods sold and shipped are properly numbered and accounted for. This is essentially going to make sure that all shipments were invoiced correctly and that there were no errors, such as missed shipments or invoicing the same shipment twice. Okay, but if we think about our internal control departments in step 1, and then the documentation that was created by management in step 2, we would know the 3 primary documents that are created, and it would make sense for the shipping document to come before the sales invoice. So tracing from that document to the invoice will allow us to identify that shipments to customers are properly invoiced. Okay, so the whole reason that the accountant is looking at this sales order and this shipping doc is to make sure that they are creating the correct invoice. And that's only going to help us understand that the shipments that were made were properly invoiced. Okay, so now let's think about why the incorrect answer choices are in fact incorrect. Okay, so if we were to take a look at the incorrect answer choices, let's see why those would be incorrect. So taking a look at this first option, all pre-numbered sales invoices were accounted for. So tracing transactions from shipping documents to sales invoices would help verify that the pre-numbered sales invoices were accounted for, but it would not necessarily provide information about the accuracy of the invoicing. And this is because it's possible for invoices to be numbered and accounted for, but still contain errors or omissions. Okay, so how about all goods ordered by customers were shipped? Tracing transactions from sales invoices to shipping documents would help verify that all goods ordered by customers were shipped, but it would not necessarily provide information about the accuracy of the invoicing. So this is because it's possible for goods to be shipped, but not invoiced properly or invoicing errors to occur. Okay, so how about no duplicate shipments or billings occurred? Tracing transactions from the cash receipts journal to the sales journal would help verify that cash received was properly recorded, but it would not necessarily provide information about the accuracy of invoicing or shipments. And this is because it's possible for cash receipts to be recorded properly, but for invoicing or shipment errors to occur.
So this question is focused on custody of inventory, right? And what does that mean? Well, it means that a company, they have inventory in their warehouse. And what controls do they have in place to make sure that it's not misplaced, lost, stolen, right? Anything, right? It basically means, how do you make sure that what's in there stays there and you can end up selling it to your customers, right? That's the most important thing. So for internal controls, they can do three things, right? They can either prevent, they can detect, or they can correct. Now this question is focused on detecting errors and fraud. And again, it's concerning the custody of inventory. So again, how do we know what's in the warehouse is actually in the warehouse? So I'll help you understand better, right? So let's say that the company's inventory records say they have 100 goods on hand, right? Now the company's going to assume that those 100 goods are actually in the warehouse. But unless we go actually count those goods in the warehouse, we're not going to really know for sure. So what the company can do, well, they can perform a physical inventory count. And from the audit team, this is the physical inventory observation. And basically what happens is the employees that go into the warehouse, that count all of the items on hand, and then we compare that to the finished goods records. And if there's discrepancies, we'll want to understand why. And the reason this is good at detecting errors and fraud is because if there's a big variance, let's say that we expect there to be 100 units and really there's only 50 units. So what happened to those other 50 units? Were they stolen? Were they lost? What's going on here? So if there's one thing to remember, just remember when it comes to custody of inventory, the only way that we know for sure that it's in the warehouse is if we actually go and physically observe it being there. So from the company, they go observe and count it. From the auditor's perspective, we go and we observe them counting it, and then we also perform our own count procedures. So overall, this is called a physical inventory observation. Most companies do it at least at the end of the year, and sometimes more often, right, if they think there are issues. So the correct answer here is going to be independent comparisons of finished good records with counts of goods on hand, right? And the counts of goods on hand, that is where we actually go into the warehouse and count. The finished good records, that's the inventory listing that we're comparing to. So obviously, all of the other options, they're incorrect. Now, it's important to understand that they're not necessarily bad inventory controls. They should be implemented. They just relate more to the financial statement presentation of inventory and not necessarily the custody of inventory. So in this question, it says that the audit team, they perform substantive tests on a client's property and equipment balance as of the interim date. So an interim date, that occurs before the actual reporting date. And when it comes to the balance sheet, well, obviously the balance sheet, it's audited as of the reporting date. So most commonly, right, that'd be December 31st. So an interim date here could be June 30th. Right? So the audit team, they perform substantive testing on the property and equipment balance through June 30th. Now, if it's, a low risk balance, then maybe they could rely on controls through the end of the period. But unfortunately, the audit team did not obtain any evidence about the operating effectiveness of relevant controls. So the issue is that, well, obviously they're auditing the December 31st balance sheet amount for property and equipment, but they've only substantively tested the balance through June 30th. So we have this massive gap here where the property, plant, and equipment balance, it's going to change, right? Most commonly because they're either going to add more property and equipment through additions, they might dispose, we're obviously going to have depreciation and accumulated depreciation. Right? So how can they go ahead and roll forward their work from the interim dates to year end? Well, like I said, normally sometimes you could rely on some controls, but here they don't have any control reliance. So all they can do is perform substantive procedures for the period between the interim date and the balance sheet date, right? That's going to be the correct answer here. That's the only way that they can extend their audit conclusions from the interim date all the way to the balance sheet date, which is obviously what matters in the audited financial statements. Now, this is very common, right? For big public company audits, it's just too much work to wait till the end of the year, right? So you have the audit team, they're out there all year. And so what they'll do is test balance sheet accounts as of interim dates, right? So either June 30th, like I mentioned, could also be September 30th. It could be any date. Right? And the idea is to minimize the amount of work that is needed to be performed as of the reporting date, which is December 31st, because that is a tight timeline otherwise. But they still need to perform some procedures to roll forward their substantive work so that the same conclusion can be reached as of the reporting date. And more often than not, that's just testing a few more items, right? So let's say that they tested 40 items for the year. Well, they might test 30 through an interim period, and then they'll leave a few more sample testing to be done at the end of the year, right? That's how they can roll forward the conclusion and still say, okay, we feel comfortable that, property and equipment balances reasonably stated here based on our substantive testing procedures performed throughout the whole year, right? So all we need to remember is that at some point, we need to perform some procedures to roll forward our audit conclusion from that interim date to the conclusion date. We cannot just leave that and assume that the balance and the conclusions we reach as of the interim date are still correct, because it's going to change, right? That's the reality. So keep that in mind, but that is the real world application of how we can understand what this question is asking about. In this question, we're focused on providing the best audit evidence to test the existence assertion as it relates to the accounts receivable balance. So the phrase best audit evidence, it suggests that the question could have other types of evidence that would test the existence assertion, but we're looking for the best audit evidence. So when we think about the hierarchy of audit evidence, well, some audit evidence is more impactful or more important than other forms of evidence, right? And that's what would go towards being the best audit evidence. So as you can see in the visual, well, direct and personal knowledge, right? Actually seeing it or talking to the company's customers and saying, okay, do you actually owe them money? Now, the next best piece of evidence is external evidence, which is when we would send, say, a confirmation to the customer. We're asking the customer to say, do you owe the company this amount of money? And if not, what amount do you owe them, or do you owe them anything at all? Because when we receive that confirmation from, say, the customer, it would come through and say, yes, I owe them this amount of money. From the auditor's perspective, that would help test the existence assertion about whether the receivable actually exists and it's with a valid customer. Right, so when we look through the options, well, there's one that relates to confirmations. It says obtaining confirmations of receivables directly from customers. So we're not going through our clients. We're going directly to the customer. We're sending them confirmations and asking them to confirm the receivable balance that the company says they owe. Now, we don't know if this is the best option yet, so let's go through the other ones. So the next one says tracing sales register selections into the accounts receivable listing. So basically here it's just saying, okay, they recorded a sale. Is that sale also in the receivable listing? It may not be. The customer could have paid them already. But what this does do is help test the potential completeness of sales transactions in the accounts receivable listing. But honestly, this isn't a great procedure at all. So let's call it incorrect. How about obtaining a management representation letter regarding accounts receivable? So towards the end of the audit, the CEO, CFO, and maybe some other individuals would sign a representation letter saying basically that everything that they told the audit team is correct and that there's nothing that's being missed, right? And in this would be kind of saying that the accounts receivables that we say our customers owe us, they actually owe us. But again, this is just a more of a formality. It's not the best form of audit evidence for testing existence for accounts receivable. Certainly not better than obtaining confirmations, so that's why that option's incorrect. And then the last one, testing shipping cutoff procedures. So what this focuses on is saying, okay, we sent a customer a shipment. Was it before the end of the year or after the end of the year? Right? If our end date is December 31st and we ship it on December 30th, then the customer is going to likely owe us money. But if we shipped it after, say on January 2nd, well, it's not a valid receivable at year end. But that's testing the cutoff assertion, which focuses on making sure that the transactions are recorded in the proper period. It's not so focused on the existence of the accounts receivable balance, right? So not as good as obtaining confirmations of receivables directly from customers. At the end of the day, for both the cash and accounts receivable balances, sending confirmations is the highest form of evidence we can get for those balances to test the existence assertion, right? So we have our correct answer. think through these types of questions, ask the questions to yourself, think like an auditor, right? That's what you want to do here. So in the question here, it tells us about accounts receivable, and then it asks us which assertion should they be considering, right, from the auditor's perspective. So the first thing we need to think about is what type of account is being addressed, right? And then we think about what category of assertions does this question relate to? And since it's talking about accounts receivable, well, that's a balance sheet account. So we're going to be talking about the account balance category of assertions. Now, as we move on, right, the audit team basically decides, okay, it's a bit of an issue that the client doesn't review the collectability of their accounts receivable balances. So what does that mean? Well, that means that the company, they have outstanding AR with customers. And what they should be doing is trying to assess, well, are the customers actually going to pay me back? Or if they don't pay me back, right, that becomes bad debt. So if you recall from financial, right, from FAR, under US GAAP, well, we would state the accounts receivable balance at the net realizable value. So what exactly does that mean? Well, on our balance sheet, we have our gross accounts receivable, which represents 100% of the money that our customers actually owe us. But for most companies, right, there is some portion of that balance that won't be collected. And that is why we establish an allowance for doubtful accounts. Now, every company is going to have a different way for assessing the collectability of their accounts receivable balances. But the point is that if some level of receivables isn't expected to be collected, well, that should be covered in the allowance for doubtful accounts. And that's a contra asset because it reduces the gross accounts receivable balance. So as you can see in the visual, right, the gross accounts receivable, that would be 100. And then the company's saying, okay, well, of that 100, there's $20 that we don't think we'll collect. So that's our allowance for doubtful accounts. And that gets us down to the accounts receivable net of $80. And that $80, well, that is the net realizable value, which is the amount of cash they actually expect to collect from their customers. So the overall point here, right, is it's addressing, is the accounts receivable balance on the financial statements appropriately valued? So if that makes sense to you, then obviously the valuation assertion is what this is addressing. You would assess the collectability of those accounts receivable balances to make sure that accounts receivable is stated at net realizable value. And overall, that is addressing the valuation assertion, which again is management's way of saying our accounts receivable balances are appropriately valued on our balance sheet. So the correct answer is going to be valuation. Now, one of the things that also helps here, right, is thinking about what type of documentation or reports the audit team could use to inspect whether the accounts receivable balances are adequately reflecting customers that might not pay. So one of the key documents that you could look at is the accounts receivable aging listing, which shows how many days past due that invoice is. So if it's supposed to be paid within 30 days, but based on that invoice date, well, it's been 90 days. Well, the longer you get past that due date, probably the less likely is that the customer is actually going to pay, right? So that becomes a doubtful account. So that's one piece of documentation that you could use to assess the collectability of that outstanding accounts receivable balances.